My name is Dr. Deepika Tapadia, Assistant Professor, Jagannath University, Jaipur. Today I'll be discussing an important topic, that is technique of capital budgeting. Previously we have already discussed what do you mean by capital budgeting. Basically, capital budgeting, it is a technique through which we evaluate the best project out of various projects. Many of the organization uses capital budgeting technique to evaluate the project so that the company can earn good profit out of the project. So there are few techniques through which companies evaluate the project, which project is best for the company. There are few techniques. Basically, we have divided the capital budgeting technique into two broad categories, that is traditional techniques and discounted cash flow technique. These are the two broad categories of evaluating the capital budgeting techniques, evaluating the project of the company. First is traditional technique. In traditional technique, we have three main techniques, that is urgency method, payback period method, average rate of return method. These are the three traditional techniques of evaluating the project of the company. Second is discounted cash flow technique. In discounted cash flow technique, we have the three techniques. First is net present value technique, which is also known as NPV method. Second is profitability index, which is also known as PI. And third is internal rate of return, which is also known as IRR method. So these are the traditional technique of evaluating the project and the discounted cash flow technique, which is also known as modern technique of evaluating the project. Starting with the first technique, that is traditional technique. Basically, traditional technique does not take into consideration the time value of money, but the modern technique take into consideration the time value of money. So starting with the first traditional technique is urgency method. Urgency is basically the criteria just to justify the acceptance of capital project on the basis of emergency requirement. So this means this technique is only used in under the condition of crisis or in emergency condition. Under this method, the most urgent project is taken into consideration. Say for example, if the organization it is into manufacturing industry, and organization is producing something, they are manufacturing something, and suddenly the machine shut down. So it is a very emergency condition for the company. They have to come up with a new machine. They have to, in an urgent basis, they have to select a new machine for the company so that they can start their production, because they have their deadline, they have to finish the goods in a particular time bound. So in that condition, they need some machine in an urgent basis. So in that condition, they don't have any time being for calculations, for techniques. So this method is known as urgency method. In this method, they come up with any of the machine they are getting in urgent basis. Second important method is payback period method. This method is the most common and the old method, traditional method of capital budgeting. Payback period, it is the length of time required to recover the initial cost of the project. So in this method, basically the project where the principal amount, we have invested principal amount. For example, we have invested the principal amount in three different projects, project A, project B and project C, and in which project we get the principal amount earlier, that project will be selected. So that is known as payback period method. In short, it is the period required to recover the cost of investment, what we have invested. So payback period method is also known as payout or payoff method. Basically, we have divided, just for the calculation, we have divided payback period method into two broad categories, that is when the annual cash inflow are equal and when the annual cash inflow are unequal. So based on the cash inflow, we will calculate the payback period method. So first situation, when the cash inflow are equal, it means when every year we are getting the same cash inflow. Just say for example, every year we are getting 10,000. Each year the cash inflow is same. In that situation, what will be the formula? So payback period is equal to original cost of the project upon annual net cash inflow. This is the method to calculate payback period method in that situation where the cash inflow is equal. This is the example. Say for example, if the project involves a cash outlay of 10 lakh and generated cash inflow of 2 lakh annually. Annually the project is generating the cash inflow. So what will be the payback period? So the formula is cost of the project upon annual cash inflow. Cost of the project is 10 lakh and annual cash inflow is 2 lakh. So the payback period will be 5 years. It means 5 years is required to recover the original investment which is invested in the project, that is 10 lakh. 10 lakh is invested for the project and we will recover the 10 lakh in 5 years. This is known as payback period method. Next is when annual cash inflow is unequal. This is the second situation where cash inflow is unequal. In that situation, how we will calculate the payback period? So in that situation, basically the cumulative cash inflow is calculated, and after that cumulative cash inflow, when it becomes equals to initial investment, we have to check where the cumulative cash inflow equals the cash inflow. So this is the situation where the annual cash inflow is unequal. So say for example, if the cost of the project is 1 lakh and the cash inflow in first year it is 10,000, second year it is 15,000, third year it is 25,000, fourth year it is 30,000, and fifth year it is 30,000. It shows every year the cash inflow is different. So in that situation, basically payback period to recover original investment of rupees 1 lakh comes to 4 years and 8 months. That is 80,000 is recovered in fourth year, and to recover the balance of 20,000, 8 months is required. This is the formula how to calculate the payback period method in case of unequal cash inflow. Next is post payback method. Under payback method, basically the profitability does not take into consideration, we ignore the profitability. So the next method is post payback method. The entire cash inflow generated from the project during its working life are taken into account in this method. So the formula of this method is payback profitability is equal to total cash inflow in life minus initial cost. Say for example, if the cost of the project is rupees 1 lakh and the cash inflow are first year it is 10,000, second year 15,000, third year 25,000, fourth year 30,000 and fifth year 30,000. And how we will calculate post payback profitability? So post payback profitability is equal to total cash inflow in life minus initial cost. So total cash inflow in life, we have to total it. It is 1,10,000 minus initial cost, that is 1 lakh. So the post payback profitability will be 10,000. Next is average rate of return method. This is the last method of traditional technique. In this method is also known as accounting rate of return method. Under this method, average annual profit after tax and after depreciation is expressed in the form of percentage. So this is the formula. Average rate of return is also known as ARR method. The formula is average annual income after tax and depreciation upon average investment multiplied by 100. So this is the formula to calculate average rate of return. The basic difference between annual income, what we take into consideration average rate of return, and cash inflow, the basic difference is that In average rate of return, we take income after tax and after depreciation, but in payback period method, we include cash inflow. And what is the basic formula of cash inflow? Cash inflow is basically net income or net earning or net profit after tax but before depreciation. This is the basic difference between cash inflow and income. Next is discounted cash flow method, which is also known as modern method. So basically the drawback of traditional method was that it does not take into consideration the time value of money, but in modern method we take into consideration the time value of money. So these are the three methods used in discounted cash flow technique or in modern method. First is NPV, which is also known as net present value method. Next is profitability index, which is also known as PI. And third is IRR, that is internal rate of return method. So starting with the first method, that is NPV. NPV, the full form is net present value method. In this method, basically we take into consideration the present value of cash inflow and the present value of cash outflow. The cash inflow, we have to calculate the present value of the cash inflow and the present value of cash outflow, and it has to be subtracted. This is the formula: net present value is equal to present value of cash inflow minus present value of cash outflow. This is the formula to calculate net present value. Next is profitability index, which is also known as PI. Profitability index, the formula is present value of cash inflow upon present value of cash outflow. So the basic criteria of selection of the project in case of net present value, if the company wants to select any of the project based on net present value method, then what the company will see, if the result which we are getting from the project, the result of net present value is positive, then automatically the company will select the project. And on the other side, if the result is negative, the company will reject the project. Second is profitability index. The basic criteria of selecting the project in case of profitability index is that if the result is greater than equal to 1, then the project will be accepted. On the other side, if the result, the value comes less than 1 or in negative,